But I want to discuss, as always, a recently posted content. Some of the webinars we posted from the last open forum Q&A session and other presentations. A discussion on can you protect a poor man's covered call. The calendar spread, buying an in-the-money call and selling an at or out-of-the-money call option. Using that as leverage to simulate stock ownership, but can you protect that the same way as you could protect a stock with a married put? We discuss why that is not the same type of structure and what you might want to look out for with trying to protect the poor man's covered call by adding the put we use in the married put technique versus just using the standard stock plus put technique we use in the married put. Another discussion, a little bit more complicated, can I use a calendar put to enter a married put? In other words, instead of buying the stock and put combination, what if I sold an at or just out of the money put and bought the put I would for a married put? Does that work the same way? The answer is no, and that webinar describes why. Covered calls and cash secured puts, a brief discussion on parity. We always want to review that from time to time, especially when several questions come in, which they did during that trading week, about the parity adjustment between, say, an in-the-money covered call and an out-of-the-money cash secured put with the same strike price and same expiration date. How are they the same? How are they a little different? And what are some of the things you might want to look out for in each one? And then we had a question posed to us about analyzing 0 days to expiration iron condor positions, opening an iron condor on SPY, for example, or SPX that now have Monday, Tuesday, Wednesday, Thursday, and Friday expirations, but opening an iron condor that morning and then closing it if you reach 50% profit, or trying to close it if you've reached a reasonable profit before the close of that day. So trying to open a trade and close it every day. Didn't turn out very well from what we tried to do in that case, but you might want to check that out if you're interested in that theory. It hasn't worked out, and with yesterday's, or the other day's movement, I should say, in the market, we had to actually manage one of the 3 iron condors that we entered in the shortened trading week for Thanksgiving. It never entered a profitability range where we had to manage it to about 3 weeks out in time. And now it is at a major loss because of the gap up that we saw due to the Powell comments. So the repair now needs a repair as well, taking down, I should say increasing the losses that we were taking on the 0 days to expiration iron condor approach that we tried to analyze last week. Now, all that being said, I'm going to navigate over, but instead of navigating over to power options, which we normally do, I'm going to navigate over to our YouTube channel real quick. Excuse me, folks. And the reason why I want to do that is I just want to share with everyone here. You can, of course, view all our recent videos. You just saw that, but you can also take a look at the various, there we go. You can take a look at the videos we just mentioned, also the various playlists we have on different strategies and other content as well. Paul is with us today, and Paul had sent me an email earlier this morning, and he was in a married put on PXD, and as the stock moved up, he adjusted the put, what we call income method number 4. We're not going to go through Paul's trade. The reason why Paul was relatively attracted to stock PXD, I believe, is because it was releasing a special dividend. And we've had recent discussions on that as to why stocks that have a special dividend or pay a high dividend are not the approach that we want to use for the married put position. One of the recent ones here is a quick look at stock PBR. In this video, we were asked about what are your thoughts on PBR, and we took a look at it. A special dividend is coming up. Now, you know the stock is going to drop by the amount of the special dividend is paid, but you still receive that in your account to counter that loss. But does that mean that it's free money, that you can just buy the stock, be on record of owning the stock before the ex-dividend date or the required ownership date before the special dividend, sell a call to get extra premium and make money? No, it does not. There is no free money in the market. At the same time, if I open a married put position by buying a stock and buying a put, so I'm controlling my risk to low percentages, can I do that on a special dividend paying stock where, hey, if I'm going to get a 6% dividend and normally I only risk 4 or 5%, won't I automatically make a profit? The answer is no, because another video that we discuss is the dividend being priced in to the put option as well. So in addition to the quick look at PBR, let me try to do a search here for dividend put. High dividend stocks with a married put doesn't really work out. I'm sorry, there's the one I wanted about a month ago. Are dividends priced into the put purchase in a married put position? And the answer is yes. They will always have a higher at risk compared to stocks with the same price, same strike price, and similar expiration of the put option to protect it. But with a special dividend payment, the risk is going to be much higher. And when the dividend, that special dividend is paid or the high dividend is paid, you see the stock, depending on market conditions, but you see the stock essentially drop by the amount of the dividend. And you'll also see your put option, your second asset, decline suddenly as well because it was priced into the put option when you purchased it. Your risk would have been 2 times or 3 times as much as a standard risk of a stock with a similar price, similar strike price, and similar expiration date, where we might only see 5% or 6% at risk with a normal married put, let's say on a $30 stock with our preferred structure that doesn't pay a dividend or maybe only pays a 1 or 2% dividend, whereas a $30 stock with the same preferred structure that pays a special dividend or has a dividend of 8, 9, 10, maybe 12%, the risk would be at 13, 14, or 15% as opposed to 5 or 6. So it's not a good idea. There is no free money. You think you can control risk to 5 or 6% and collect a 13, 14% dividend. It doesn't work out that way. And these two discussions emphasize that. Are dividends priced in the put purchase, the married put position? Yes, they are. And that's why they don't work. And then that previous one, of course, we just mentioned from a couple weeks ago, a quick look at stock PBR. And unfortunately for Paul, that's the trap that he fell into with his position. Even though he used one of the income methods to adjust the put to lower the risk, he still didn't end up with a profit on the position while collecting the special dividends because the stock dropped in the amount of the dividend and the put also decreased after he had moved up to the new strike based on the amount. So 2 assets he owned declined by the amount or close to it. He collected one back. That's why it is always important, if you're going to follow the married put approach, to have the blueprint and to have the full insights into the structure and all 12 income methods, when and how to use them. Income method number 10 in the blueprint discusses using dividend paying stocks, what's preferred and what should be avoided in these cases. And that's what we see here with those special dividend paying stocks, high dividend paying stocks, and why there is no free money with a protected position and a high dividend paying stock.